Next, we're going to go over Work Together 14-3. And to start with, we will be in the first part of it. And it says, for each of the notes signed by PLD Incorporated, complete the following tables. Use the first table to show your calculations of the maturity date of the note, the interest of the note, and the maturity value of the note. And then we're going to use the second table to show the total interest, the maturity date, and the total maturity value. And then we'll take this information and then we'll go through and record it in a journal. So our first note is right here. We're going to use that information for our first note and fill in the table. So you can see we're going to take a look at the days of the month and the days remaining. The first date is the 25th. The 5th of June. So in June, right down here, how many days are left in June? There are 30 days in June. If we started the note on June 5th, that would mean that there are 25 days left. Then we will take 90 days. We'll take 90 days. Whoops, sorry about that. Let's get a smaller pencil. 90 days right here, minus 25. And we should come up with 65 days left in the note after June. Okay, so we have 65. And in July, there's 31 days. So if we take 65 minus 31, we should have 34 days left in the note. So we're going to go into August. Okay, now we're into August. And again, we have 34 days left on the note. August, there are 31 days. So 34 minus 31 equals 3. We have 3 days left. So those are since there's 30 days in September, we're only going to use 3 of them. And that would take us down to 0 days remaining. So the maturity date of the note would be September 3rd. Okay, next we're going to figure out the interest on this note. The principal is $20,000. Then we're going to take it times the interest rate. And if you look up at the problem up here, you'll see that the interest rate is 8%. And we're taking it for 90 days. So the portion of the year that we're using is 90 over 360. So if we take that formula, 20,000 times 8%, times 90, we will get the amount of the interest. Okay, so and we should come up with, if we take that, we come up with $400 interest. Okay, then we're going to take our principal of $20,000 plus our interest would be our maturity value. So the maturity value of this note is $20,400. Moving on to the second note. The second note is here. It's June 12th, the date of the note. It's 10,006% for 120 days. Okay, so we started the note on June 12th. There are 18 days till the end of the month. 120 minus 18 equals 102. Okay, then July has 31 days minus 31, and you'll come up with 71 days left. Okay, then August has 31 days, and you have 40 days left. Going into September, there are 30 days in September. So there'll be 10 days left. October, there are 31 days. We're not going to use all 30. We're only going to use the 10 days left to get down to 0 days. Okay, so our maturity date then is October 10th. Okay, next to figure out how much interest, we'll take the principal of $10,000 times the interest rate of 6%. It was for 120 days out of the 360. And if you figure out this, 10,000 times 6% times 120 divided by 360, you should come up with $200 interest. Okay, then to figure out our maturity value, how much it's worth when it's matured, we take the principal plus the interest. Okay, next to figure out the table below, we're just going to plug in some numbers. The first one, we had interest of $400 that we figured out up there. Maturity date was September 3rd. And the maturity value would be adding those two numbers together. The second note, the interest we figured out right here. The maturity date was right here. And the maturity value is figuring that out right there. You add those two together and you come up with your maturity value. So that's how you go through and you figure out maturity date, interest, and maturity value. Moving on to part 2 now, we are going to journalize. If you look here, it says journalize the following transactions completed during July of the current year. Use page 7 of the general journal and page 8 of the cash receipts journal. Okay, so you have your transactions right here, the 3 transactions that we covered in this section. The first one is on July 5th, we accepted a 90-day 8% note from Gary Kinney for an extension of his time on his account, $1,800, and it's notes receivable number 5. Okay, we're not receiving any cash, so we're going to go to our general journal. The date is July 5th. We are creating a notes receivable. Basically switching it from accounts payable to notes receivable because he needs a little bit more time. Notes receivable is an asset. We're increasing that amount by $1,800. We're going to credit accounts receivable. We're taking it out of his account because we're putting it into like a loan or a notes receivable for $1,800. And source document is notes receivable NR5. So again, it's just a note, switching it over from your accounts receivable to a notes receivable. And again, we create a promissory note that's you can withhold in court. All right, the second transaction, receive cash from Mary Jane's for the maturity value of notes receivable 1, 60-day 9% note of $500, and you have receipt 113. Since you see these two words here, receive cash, we have to use the cash receipts journal. Okay, so our first thing is the date is July 12th. She's paying off her notes receivable. The notes receivable amount was $500, so she's paying that off. So we will credit that. Remember, it's an asset. When we pay it off, we're going to credit it. The next thing we have to record is the interest income. Remember, that is a revenue account with a normal credit balance. Okay, to figure out how much she paid in interest, we need to go through and figure out the problem for it. Okay, so to figure out the interest, we take the principal of 500 times our interest rate times the number of days divided by the portion of the year, 360. So if we plug that into our calculator, we would come up with $7.50 interest. Okay, so we'll go down here and we'll record $7.50 in interest. How much cash did you receive? You received $500 for the principal plus $750, which is the maturity value. And you would have received, for some reason, this cash debit column was cut off, but it is $507.50. Okay, that's receiving cash. The third one is our third transaction. Dennis Kraft discovered dishonored NR2 a 90-day 9% note of $400. Okay, so he's dishonoring his note. Okay, we're going to go to our general journal. Write the date. It's July 26th. Dennis Kraft is now going to owe us some money. Okay, so we have to put it back. We're going to receive it, so we have to have accounts receivable, Dennis Kraft. And we'll come back with the amount in just a second here. But the total amount for the note and the interest, our maturity value, has to go into his account because he took out the note. He still has to pay the interest. Okay, the other two accounts affected are our notes receivable and our interest income. Okay, he dishonored it, so we're not going to get our notes receivable, so we have to take out the $400 out of our notes receivable. So we're going to decrease our notes receivable, and we're going to increase the amount of interest that we're going to receive. That's why we will credit interest income, because it's a revenue account. Okay, how much does Dennis owe us? He owes us the $400 in principal plus the $9 in interest. So he owes us $409. And so we will debit his account for that. Remember, a note receivable is like a small loan. If you dishonor it, you still have to pay the interest that is attached to it. The third part of the problem is to go through and post the transactions in the general journal to the general ledger and the accounts receivable ledger when each transaction is journalized. Okay? So you can go through and post. You know how to do that. I'm not going to walk you through that.